On today's class, we'll be discussing about the controversial topic, is Forex gambling? But really, is Forex gambling? We'll look into the table of contents. Before we begin, like and click on the notification bell button to not miss educative classes like this. So we'll talk about today Forex trading and why it is not gambling. Similarities with gambling, applying proper risk management in Forex, the act of responsible trading, and in conclusion, we'll recap the key points. Who is a gambler? A person who plays games of chance for money. Who is a Forex trader? A Forex trader anticipates changes in the price of currency in the market to profit from its demand or supply. If you have noticed, I highlighted the word chance and anticipate. If you're playing a game of chance, you're playing a game of uncertainty. And if you are anticipating, it means you are waiting for something. And I believe for a successful trader, you should be waiting for a confirmation. Now, who predicts and who reacts? You guessed it right. A gambler predicts and a Forex trader reacts. Now, a tit for tat on a highlighted version of prediction and reaction. Now, this is a slim line between one who predicts and who reacts. If you're late for an occasion and you call a cabbie, if you think he'll show up in time, you are predicting. If you think because you told him it's an emergency, you are predicting. If you think he'll show up because you told him you are running late, you are also predicting. And an extra point. If you tell him an hour before and claim you are late, you are still predicting. Now, when you consider the environmental conditions, personal preferences, past experiences, social influence, emotions and values in the cabbie man, if they all check out, then you can take action. So in conclusion, they would have to be in accordance to your new or your view. If they don't check out, then the possibilities of making it to the event becomes low. That's the edge to trading and gambling. This, however, can function in other aspects of life, but this is the Forex class, so we're moving forward. So on the left side is the consequences for a person who predicts, and on the right side is the difference between a predictor and a reactor. So from the previous slide, we can all come to a conclusion that Forex trading is not gambling if you have all your tools right. The tools to Forex guides you to the path of success. and financial freedom, as we all call it. Analytical precision, strategic decision-making, informed planning, prioritize knowledge because knowledge indeed is power or a cause. Just kidding. Perfecting your skills, as skills are the X factor. Now the key is a well thought out plan, knowing when to enter and exit, managing risks and setting profit goals, making Forex less luck and more of informed planning. Irregardless of my intent to differentiate between them both, there are also similarities that convey the masses to such a verdict. Before we strike forward, I'd like to inform you that gambling can be visible in all aspects of life. If you desire success or growth, but spend time having fun, then working, emphasis on working right, you are simply gambling with your future. You're gambling with your time and your future. Back to class. The very known similarities are financial, habitual, and emotional sectors, like risk uncertainty, emotional roller coaster. Discipline is very crucial, financial commitment, skills, and strategy. There are usually bursts of emotions, excitement when you win, and disappointment when you lose. Being disciplined is crucial because you are committing your money and you need a strategy to increase your chances of success. Even smart gamblers use skills and plans to make a better decision. Risk management is like a protective forefront and a lifeguard because it preserves your capital. It provides consistent and sustainable trading, emotional stability, because you'll be risking the bare minimum. Increase confidence. Please, no matter how confident you are, you do not want to lend money to trade. Adaptability to the market changes. You also do not want to use the money for necessity to trade. When you don't lose big money in your capital, it gives you the opportunity to keep playing in the market. And when you are confident and a good trader, you make a better shot at profiting in the market. Try not to be too confident. We'll talk about this in psychology class. In summary, you apply an RM, you get yourself an RM. Just kidding. When you apply a proper RM, risk management, of course, you set yourself up for consistent and sustainable success in the new journey of Forex you'd like to embark on. Always practice responsible trading in Forex. Continuous education from the right source, emphasis on the right source, as our brain is a vacuum to take in garbages. And that's however the media puts things in our thoughts. Discipline and risk management. Risk management is a constant or is on constant repeat because of the great importance. The more volume of money you lose, the less confident you are. Adherence to a trading plan. A trading plan keeps you in check and suppresses your emotions. There's a trading plan and there's a trading strategy. We'll talk about this at the right time. Reflective review. Looking back at your trades help you learn from both success and mistakes. It gives you the incentive that your plan and strategy is correct and gives you the ability to know you will be successful over time. Now, for those who were patient enough to watch all through, here's your reward. A cheat sheet. Yes, a cheat sheet. Do you know you can actually fail majority of your trades and still set yourself up for success? Now you know. With the contribution of risk to reward ratio, you can attain this through a technique called the RT, the ratio technique. Here it is. If you have a risk to reward ratio, you would not trade over time, you would not overtrade, but you would trade when you see the opportunity. What is an opportunity? Your setup. And what is a setup? From your analysis. And when we get into that class, you'll be able to have a perfect setup and know when to tap into the market and make your substantial profits. Which is your desired? Now you trade when you see the opportunity, which is your desired risk to reward ratio, setting you up for success. Now a $10 trade to our 1.5 reward sets you up for a $10 after losing 7 trades out of 10. Yes, 7 trades out of 10. You still make a $10 profit, which gives you the money you had invested in the market. And 140 after losing 6 trades out of 10. So you're below the average and you still made a whooping $140. And as an average trader, you make $200 when you break even with 5 losses to 5 wins. And 260 after losing 4 trades out of 10. And as a veteran trader, you make $320 after losing 3 trades out of 7. And $380 after losing 2 trades out of 8. If you have noticed, I had skipped 9 and a perfect 10 because it is impossible not to lose a trade. And that is why risk management and a stop loss is important. Click on the bell button and subscribe not to miss on real content like this, and see you in the next class.